Welcome everyone to S&C's webinar on the SEC's proposed climate-related disclosure rules. I'm Sarah Payne, co-head of S&C's Capital Markets Group and based out here in Palo Alto. Leading today's discussion is Jay Clayton, former SEC chair and current senior policy advisor and of counsel at S&C. Also joining the panel today are Cathy Clarkin and Bob Downs, co-heads of our Capital Markets Group, and Marc Treviño, co-head of our corporate governance practice. By way of a brief roadmap for today's discussion, we'll first give a short overview of the proposed rules. Then Jay will provide his take on the rules, and we'll then do a deeper dive on some of the key implications. We'll follow that with some thoughts on where the proposals go from here. And at the end, we'll have time for Q&A. During the webinar, please submit any questions you have to the Q&A feature that you'll see on your screen. With that, I'm going to turn it over to Cathy.
Thanks, Sarah, and good afternoon, everyone. As we all know by now, last Monday, the SEC issued their highly anticipated climate-related rule proposals, and these proposed rules are extensive, over 500 pages in length in the adopting release. They're highly complex, and they're already generating significant debate. And at a high level, the rules would require, they would expand both the breadth and the specificity of climate-related disclosures for both U.S. public companies as well as for foreign private issuers. And in many instances, the rules call for information regardless of its materiality, which is a significant departure from the SEC's traditional materiality-based framework of disclosure. And this really represents a move towards a more prescriptive, climate-related disclosure regime. It's important to note here that the disclosures will be mandated in an SEC's periodic reports or registration statement. Contrast that with today, where companies disclose a lot of this information in their sustainability or ESG reports. So that obviously has significant implications for disclosure controls and procedures and improving the quality of the information that's currently presented. So while these disclosures really are based in part on the recommendations of the TCFD, and as we know, the TCFD framework has been widely adopted by companies globally, there are some significant departures here that require more information than what companies currently disclose voluntarily under TCFD. And to give you just a broad sense of the rules, I'm going to cover the 5 areas that we kind of think about them under and just walk through at a high level. And the first is greenhouse gas emissions. Companies will be required to disclose both Scope 1 and Scope 2 emissions, regardless of materiality, and Scope 3 emissions to the extent material or to the extent it's referenced in a target or metric used by the company. The rules here are quite detailed, and Sarah's going to walk us through them. The important thing to be mindful of here is that these Scope 1 and Scope 2 disclosures would be subject to attestation by a third party. The second category is climate-related risks and their impacts. And here, companies would be required to provide narrative disclosures about climate-related risks on their business strategy and outlook over the short, medium, and long term, as well as the impacts those risks have on business activities. In terms of the third category, which is transition plans and climate-related metrics or targets, this is important because if a company has disclosed or adopted transition plans or uses targets, they'd be required to disclose them. And they'd also be required to report against their progress in achieving them. The fourth area that we'll talk about is climate-related financial metrics. And for me, this was the most surprising aspect of the proposal, and Bob will walk us through it. But at a high level, it requires information in the company's audited, in the notes of their audited financial statements. And finally, governance. And while there's no prescribed rules here around practices, there's certainly a lot of disclosures a company would be required to provide with respect to their oversight of governance of climate-related risks. And Marc will walk us through that. So there's a lot here to be thinking about, and certainly significant implications for public companies. From a implementation perspective, assuming the rules are adopted as proposed, I think the SEC is shooting for the end of the year, which would mean they would go into effect in respect to fiscal 2023, which would be reported on in 2024. So we're going to talk about in the panel today, what companies can and should be doing to prepare for this, because it's obviously going to be a heavy lift in many respects, depending upon where a company is in their reporting maturity on ESG matters. So with that, let me turn it over to Jay to get his perspective.
Thanks, Cathy, and thanks, Sarah. It's nice to be with you. Let me start with a what I'll say are a couple of disclaimers and personal views. So you have my perspective in order to assess my comments. First is that assessing climate risks, that's physical risks, regulatory risks, policy risks, consumer preference risks, transition risks, and of course, technology risks and opportunities, is a key consideration for management and therefore investors, particularly in sectors that have significant emissions or rely on customers or suppliers that have significant emissions. It's also a broad policy issue, as we've seen recently. Investing is just one part of an overall climate policy for the country. Let's also note that the risks that I just listed, multiple categories, are very different from sector to sector and company to company. Something that would need to be accommodated, I believe, in any responsible regulatory policy. Let's turn to administrative agencies like the SEC, also the EPA, the FCC, the FDA. They've served this country very well. My personal view is that their effectiveness is enhanced when they stay within their legal lane and their areas of expertise. I also think it can be eroded when they step too far outside their legal lane or their areas of expertise. Those issues may in fact end up front and center here, given the scope and the breadth of the SEC's proposals. You can find more detail about my personal views in this regard in last Monday's op-ed in the Wall Street Journal, if you're so interested. So let's turn to the proposals from a broad perspective. I think one constructive, insightful, or way to look at this that facilitates analysis is it's really a separate disclosure regime that is modeled on and stapled to the SEC's traditional disclosure regime around financial performance, operation, and prospects. It has the same basis, which is mandatory and voluntary disclosure with liability attached for both misstatements and omissions. Note that it also adopts and expands on, and we'll get into this, an existing framework, the TCFD framework. So I can see the attractiveness of modeling a disclosure regime on the SEC's traditional disclosure regime because it's worked so well. But try to look at it as something that is modeled on, but different from. So given that perspective, let's note the differences between this disclosure regime and the traditional disclosure regime. In the SEC's own words, this parallel framework is more rigorous than the SEC framework. For example, greenhouse gases must be disclosed without regard to materiality. Financial information, existing financial information must be supplemented with climate-related financial impacts at the 1% level, as opposed to, say, a traditional 5% rule of thumb. And transition plans and scenario analyses need to be disclosed regardless of materiality. Those are departures. Another departure is that the type and source of information is vastly different in character from your traditional reporting information. For one, a great deal of it is forward-looking or based on forward-looking assumptions. Two, it relies to a great extent on third parties and estimates. And it's based on, this is actually quite important, what we expect will be useful to investors, not what they are using today. The notion here is that investors aren't using tools today because they're not available, but if we provide them, they will use them. That's a bit of a different way of going about disclosure than it's gone about in the past, where you look at what investors are using and then you codify that. So let me make one other observation about the approach here. And it's quite interesting in that there's an implicit recognition in the release that investors may be taking a portfolio approach to investing, not just a diversification portfolio approach or an indexation portfolio approach, but rather one where they may be happy to burden company A if the benefits to company B are greater than the burden at company A. That is something that is, I would say, inconsistent with our view of the paradigmatic shareholder, where you assume that the shareholder who shows up at your meeting, who votes on your policies, may have a different view on what's in the best interest of the company, but it's the best interest of the company that they're worrying about, not the best interests of another company. I think that may be an issue that we have to grapple with going forward. Let me make a few final notes here, going back to my point about administrative agencies and this being modeled on a TCFD. I would note that in the EU and the UK, this was legislative action, not administrative action. I would also note that in the EU and the UK, a disclosure-based regime is different from a disclosure-based regime modeled on SEC liability. It's apples and oranges from a liability perspective. Therefore, it's apples and oranges from a overall perspective. Last thing I'll say is that as a piece of advice here, don't be aspirational. What you're seeing is a liability regime for a great deal of forward-looking information. That is not the time to be aspirational in your disclosures. And I think that you should think about it from that perspective. And with those broad observations, I'll turn it back to Sarah.
Great, thanks, Jay. Starting first with greenhouse gas emissions disclosure. As Cathy mentioned in her introduction, the proposed rules will mandate disclosure of scope 1 and 2 greenhouse gas emissions, even if the emissions are not material to the company. They will also require disclosures on a gas by gas basis, again, even if the particular gas emission is not material to the company. And perhaps more significantly, the rules will require that accelerated filers and large accelerated filers have their scope 1 and 2 emissions data covered by an attestation report. And a few observations here. So some companies already report emissions data to the EPA. So not all of this will be entirely new, but the existing disclosures are done on a facility basis as opposed to an organization-wide basis. In addition, the proposed rules would apply to all types of companies, regardless of industry or emissions level. The attestation report that's provided for in the proposed rules must be conducted by an independent party, similar to the independence requirements that apply to audits of financial statements, with the overarching principle that the attesting party cannot be in the position of effectively auditing its own work. And therefore, as companies think about the effects of the proposed rules and next steps, they may want to begin thinking about who would provide such an attestation report as compared to who they may want to work with in terms of external third-party consultants who may help with collecting data, analyzing data, and preparing disclosures. The proposed rules also require detailed disclosure about the qualifications of the attesting party. And so one can imagine that there's going to be extended focus by investors and companies on the particular qualifications and credentials of different third-party providers. That's scope 1 and 2. Perhaps the more burdensome aspect of the proposed rules are the rules relating to scope 3 emissions disclosures. There's a lot of commentary out there already about the proposed rules. Some argue that the proposed rules don't go far enough and that the SEC should mandate scope 3 disclosures for all companies. And others emphasize the significant burden that may be placed on issuers as a result of the proposed rules. Scope 3 emissions are basically any indirect emissions other than those provided for by scope 1 and 2. And the concept is incredibly broad. It applies to the entire value chain of a company, so from suppliers at the top to consumers and customers at the bottom. They can include things like emissions from the use of a company's products by customers, as well as end-of-life treatment of products once a consumer is done with it. Another example of scope 3 emissions could be what are referred to as financed emissions. These are particularly relevant for financial institutions and investors. And as the SEC noted in the proposing release, scope 3 emissions disclosures for financial institutions would likely include the emissions from companies that the institution is providing debt financing to. So again, an incredibly broad concept. And on its face, the proposed rules do not mandate Scope 3 emissions disclosures for all companies. Instead, a company will be required to disclose Scope 3 emissions if either they are material to the company or if a company includes Scope 3 emissions in its emissions targets and goals. So first, talking about the materiality standard. We can expect that a company will actually have to do a fair amount of work to determine whether its Scope 3 emissions disclosures are material. And so even if a company ends up not having to disclose them from reliance on a lack of materiality, they likely will have to spend a fair amount of time looking at the entire value chain, figuring out where Scope 3 emissions could be, and thinking about ways to estimate those disclosures. Even if a company Scope 3 emissions are not material, if they include Scope 3 in their targets or goals, then they also will have to disclose those emissions data. And what's interesting is that the rules actually don't require or specify that a company have publicly disclosed its targets or goals for this rule to take effect. So if a company has internal targets or goals that include Scope 3, then potentially they would have to make Scope 3 emissions data public. And in some ways, interestingly, the rules may actually disincentivize companies from incorporating Scope 3 emissions into their targets and goals. Now, the SEC has recognized some of the challenges associated with Scope 3 and emissions and the incredibly broad nature of that kind of concept, and has made some limited accommodations in the proposed rules. So for example, a company may, if it's not able to estimate a particular number for Scope 3 emissions, it may provide a reasonable range of Scope 3 emissions. Companies will, though, have to disclose what gaps they have in their ability to calculate Scope 3 emissions, and also disclose the basis for its estimates and any assumptions that underlie those estimates. The SEC has also provided a safe harbor from liability for Scope 3 emissions data. In particular, those disclosures will not be deemed to be fraudulent statements unless it is shown that the disclosure was made without reasonable basis or made other than in good faith. And certainly a safe harbor from liability will be helpful for companies. But I think in our experience, companies rarely rely on safe harbors from liability when thinking about their disclosures and thinking about the controls and procedures around their disclosures. So in practice, expect that the safe harbor will likely have little effect in terms of reducing the burden on companies of the overall disclosure regime. And so in sum, as companies think about the proposed rules and the effects on the proposed rules, and we'll get into the transition periods in a few minutes, companies should start thinking about, in particular, Scope 3 emissions, what areas in their value chain, to the extent they haven't already, those emissions could be, and how they might go about estimating those emissions. With that, I'll turn it over to Cathy, who's going to discuss some of the risk and transition plan related disclosures.
Excellent, thanks, Sarah. So turning to the disclosure requirements for the climate-related risks and their impact. So here, companies would need to disclose the actual and potential climate-related risks that would have a material impact on their business over the long, short, and medium term. And interestingly here, the SEC doesn't define what these terms are, really in a nod to companies to give them flexibility to figure out what the right time horizon is for them. And so companies would need to determine what those are and disclose it. But in terms of what the narrative disclosures would require, it's very prescriptive. It would pick up, material physical and transition risks, as well as the nature of the risks that are presented. So in terms of material risks, here think about, companies need to classify them as acute or chronic. And in terms of acute, think extreme weather events. And in terms of chronic, think about, the decreased availability of water. And in terms of the material transition risks, here companies would be required to disclose how they're impacted by regulatory, technological, and market changes as it relates to climate change. So think about, what are the changing preferences of consumers, business counterparties, and investors, and what impact does that have in terms of risk mitigation, as well as how a company is adapting to climate change. And finally, a company would be required to disclose the actual and potential impacts of the identified climate-related risks on their business strategy and outlook, and how such impacts are considered as part of their strategy, their financial planning, and their capital allocation. This is one area where the SEC goes significantly beyond what companies are currently doing under the TCFD framework. They don't really touch upon the impacts and go into the level of granularity that the SEC is asking for. Unless we have a boilerplate disclosures in the adopting release, the SEC actually specifies different types of impacts companies should consider, such as the impact on the type and location of a company's properties and operations, the impact on their suppliers, as well as impacts associated with their mitigation efforts. And although the rules themselves relating to the risks are qualified by materiality, so material physical risks, material transition risks, when we're talking about the impacts of those risks, they're not similarly qualified by materiality. So that's another important distinction. So there's a couple of important takeaways here. First is, although the rules don't require the use of any particular analytical tool to assess different climate-related risks, to the extent a company uses certain analytical tools, they'd be required to describe it. So for example, scenario analysis or the use of internal carbon pricing. So for scenario analysis, if a company uses it, and many companies do, they'd be required to disclose the scenarios considered, the parameters, assumptions, and analytical choices that they've used. What are the projected financial impacts of each of the scenarios that they're considering? And again, there's no limitation here on materiality. And this is going to be important for many companies. For instance, US financial institutions, financial regulators in the US are very focused on scenario planning and scenario analysis. And so to the extent this became a requirement, that requirement would then find itself into SEC disclosures under the proposed rules. And I think just at a high level, for companies that need to assess their climate-related risks, this is a very different analysis and exercise than what companies did for their SEC reports today. And it could require companies to expend significant resources in assessing their climate risks. So for example, they could be hiring consultants to conduct physical climate risk assessments of particular assets, to assess vulnerabilities in their supply chain, as well as other vulnerabilities in other matters. Next, I want to turn to climate-related transition plans, targets, and goals. And Sarah touched upon this a bit with respect to Scope 3 emissions. But again, in the category of if you say something, you kind of now are stuck with disclosing it. So while there's no mandate to use scenario analysis, or there's no mandate to have a transition plan, to the extent a company has adopted one, or they use various metrics or targets to measure progress against that, a company would be required to include both qualitative and quantitative information about that. So for example, using different metrics, a company would be required to disclose the scope of activities and emissions covered by the target. What's the unit of measurement that they're using? Is it an absolute intensity versus a carbon intensity? What's the time horizon for achieving the target? Are there interim targets? And it goes on and on and on. And so for many companies, they have already published net zero pledges. That's become increasingly common, both in the US as well as abroad. And there's many other targets companies are setting, some voluntarily in response to different initiatives on various climate-related matters. And so not only would the company need to disclose a transition plan, but then they're going to need to disclose, in every subsequent year, the progress they've made against achieving their plan and steps they've taken to reach their targets or goals. So again, a couple of important takeaways here. There's no materiality threshold or qualification with respect to the targets or goals or the transition plan. And while some companies have adopted transition plans, others haven't, and so they'll need to think about whether or not disclosure may be required. And particularly for companies that are earlier in their stages of ESG reporting that haven't adopted it, they're going to need to think about what they want to do there. And this is going to be a push and pull between, what are the disclosure requirements versus what do investors want to hear from companies in terms of, their climate-related objectives and plans. So, I think that the takeaway here is that, before disclosing anything, think about, think about that in the context of these proposed rules and how that might be implicated. And with that, let me turn it over to Bob to talk about the new financial statement requirements.
Thank you, Cathy. So I get to speak about what I think is the most unprecedented element of the proposed rules, which are the new financial statement requirements. Our client memo also referred to these new financial statement requirements as unexpected. But given recent SEC proposed rulemakings, including proposed share repurchase disclosure rules, the Rule 10b5-1 plan, trading plan rules, beneficial ownership reporting rules, private fund rules, and cybersecurity governance and disclosure rules, I think I've decided to stop using the term unexpected. First, some background on the financial statement requirements for public companies. The federal securities laws authorize the SEC to set accounting rules, but the SEC has historically delegated the task of setting the standards for audited financial statements to the accounting standards. Since 1973, the FASB has filled that role. As a general matter, FASB promulgates accounting standards with input from the SEC and other constituencies, and the SEC interprets and enforces those standards. FASB is an industry standard setter. It's not a politically driven organization. The FASB standard setting process is a deliberate one, which can take years depending on the complexity of the matter. For example, revenue recognition took 3 years from the exposure draft to the adoption and another 3 years to implementation, which was then deferred by at least a year. So the proposed climate change rules represent a significant exception to that historical practice for standard setting with respect to financial statement disclosures. The 500-page long proposing release includes a 40-page discussion of financial statement metrics and a new Article 14 to Regulation SX. So what are these proposed financial statement metrics? They are qualitative and quantitative climate risk disclosures that are required to be included in the notes to a company's financial statements. The release for the proposed rules say these metrics should be in the financial statement footnotes because they are, in the words of the SEC, fundamental to an investor's understanding of the nature of a registrant's business and its operating prospects and financial performance, and therefore should be presented together with other disclosure about the registrant's business and its financial condition. I would note that the stated reason doesn't really describe why the financial statement footnotes are a better place than the MD&A, but that's where the SEC has proposed to have these. What we do know is that financial statement disclosures are subject to internal controls over financial reporting, ICFR, which is a very high reporting standard. So let's talk about the proposed financial statement metrics. They include what are referred to as financial impact metrics, which are required disclosures regarding the impact of climate-related risk on each financial statement line item. Following the theme here, the required disclosures are not limited to traditional concepts of materiality. Instead, the narrative disclosure is triggered if the impacted amount is 1% or more of the related line item, whether or not that impact is material to the company. Secondly, they include expenditure metrics, which are required disclosures of expenditures related to mitigating the risk of severe weather events and transition activities. As well, the expenditure metrics will be subject to the same 1% threshold as the financial impact metrics. And finally, they include what are called disclosure of financial statement estimates and assumptions, which disclose how severe weather events and transition activities affected estimates and assumptions related to the financial statements. An example of this would be disclosure of estimates made in connection with an asset impairment analysis, for instance. We believe that there are significant implications to these proposed financial statement metrics disclosures. First, certain of these disclosures require significant levels of judgment and subjectivity that go beyond the judgments that are normally part of audit procedures. Take, for example, revenues. If a company experiences a decline in sales due to consumers moving away from a company product in favor of a more environmentally friendly competing product, it seems very hard to quantify the decrease in revenues for that company attributable to that shift in consumer preference, as opposed to other effects. These judgments are difficult enough in the context of doing what we're used to in many instances of doing an MD&A, but these will now be subjected to the overlay of being reported in the financial statement footnotes and then subject to the internal controls over financial reporting. I'm guessing that this process will become a critical audit matter for many issuers that have important climate-related disclosures. Second, again, continuing the theme, the novel approach to materiality. As I noted above, the proposed amendments require disclosure of certain climate-related impacts on existing financial statement line items to the extent the aggregate impact is 1% or more of the particular line item for a given year, which is significantly below the typical quantitative standard of 5% that we look at under SAB 99. And the third impact I'd highlight is the burden of subjecting these disclosures to the audit procedures. As I mentioned previously, financial statement disclosures will be subject to internal controls over financial reporting, which is a very high reporting standard. These additional audit procedures, particularly in the early years after the rule's effectiveness, will add significant time and expense to the annual financial reporting process. Just as a point of comparison, and it's probably not a great one, but it's kind of one that we've got, is it was estimated that issuers spent over $10 billion on conflict minerals disclosures. And those obviously did not have nearly the breadth and scope of the attestation overlay of the proposed financial statement metrics disclosures that we're talking about here. Clearly significant public company resources will be spent complying with these new rules. So on that note, I'll turn it over to Mark, who's going to discuss the governance aspects of the proposed rules.
Thanks, Bob. But that's not all I'm going to discuss, just as this quick break in the middle. First of all, we have gotten questions, we are tracking them, and we will save time at the end for questions. So just confirming that we have your questions. Won't get to all of them, but we'll do our best. One of those questions was, hey, are there any materials? You heard it mentioned, I think, a couple of times. There is a memo that went out Friday morning that would be helpful if you don't have it handy. The way I find it is Googling SEC proposes expansive climate disclosure, and it should pop up for you. Third, the governance piece of this is not the longest, it is not the most complicated, but there are more governance rules than usual, so I apologize for having notes. It's hard for us governance folks to track this many particular requirements. So as Cathy said when we started, the rules don't require any specific governance practices, but don't be embarrassed if you're like, hey, I read the rules and it sure seems like they're requiring some specific governance practices. Because what they do is mandate disclosure that goes well beyond the level of detail contemplated by TCFD, well beyond the information you usually have in your proxy, and they do it in a sort of comply or explain manner that is designed to shape climate governance in the US. So what I mean, first, companies have to specify any board member or board committee responsible for the oversight of climate risk. So look, many large companies have a committee that has ESG oversight as one piece, so they can answer this question. And this question is well within the bounds of TCFD, so not bad. And once the information is in Bob's audit financial statements, the audit committee will also be an answer to this. Second question, how is the board informed about climate-related risks, and whether and how the board or board committees consider climate risk as part of the company's business strategy, risk management, or financial oversight? So this isn't really what the question is asking, but most companies that have a TCFD or sustainability report in all likelihood present that to a board committee. And so you would have an answer for that. And again, the audit committee will be implicated. Third, and this is where it got tricky for me, whether and how the board sets climate-related targets and goals, and how it oversees progress against those goals, including the establishment of any interim targets or goals. So the issue for me is, in my experience, setting climate goals is not a board function. For the vast majority of companies, it's long-term and it's intangible and it is a management function. And if you were to ask me, do I think companies who've made a net zero commitment, for example, had that resolved? That the company resolved by the board, the company will aim for net zero at 2050? I don't think they did. Maybe they talked about it to the board, maybe they told the board afterwards. But this clearly has a different implication. Fourth, identify any board member with expertise in climate-related risks with disclosure in such detail as necessary to fully describe the nature of the expertise, which is very similar to the audit committee financial expertise concept and very similar to the cyber framework that was just adopted, but it is missing the concept of the safe harbor in those two regimes, one actual and one proposed, which is sort of odd. And only after that do you get to management. And there are a series of questions about management committees and internal reporting and monitoring and in-house staff versus third-party consultants versus reporting to the board, how frequently you report to the board, how you determine the significance of climate-related risks, how you consider them, how you consider shifts in customer preferences for climate. So it is very, very detailed. It's very different from what we've experienced before, but in some ways similar. So the takeaways in this narrow space. If your first reaction is, gee, my board, company, management doesn't do this right now or anything close to it, I think you're in the mainstream. I think that would be a normal reaction to this. Second, it is much, much harder to roll back governance than it is to roll it forward. So if you decide, in light of the types of questions you're being asked, to institute enhanced board management governance reporting as a result with respect to climate, you should only do it because you're going to want to stick with it. Because reporting that you have less governance is going to be much, much harder. Third, these rules interact relatively hostilely with some of the other governance frameworks that we've built up over the 20 years since Sarbanes-Oxley. For example, like the mandatory clawback rules. And so you have to keep that in mind. And then finally, expect more to come. If you read this or heard this and you're like, hey, I feel like I'm having a minor deja vu with respect to governance. The reason is because you probably read or heard the cyber rules a couple of weeks ago, who also have similar, very targeted cyber-related governance provisions. And when you read the human capital management rules, which we know are coming, I would expect to see very similar concepts there too. So that's in the little world of governance. I'm going to turn it back over to Bob for broader implications.
Thanks, Mark. Yeah, so let's spend a few minutes on some of the key implications of the proposed rules, just to hit on a couple of topic areas to highlight. First, impact on private companies. The proposed rules do not provide a phase-in for newly public companies beyond which the phase-in that otherwise applies to all companies under the rules. As a result, the requirements to include climate-related disclosure could delay IPOs. As the phase-ins go into effect, the IPO companies are going to have to comply with the disclosures as proposed, just like other similarly situated companies will. Also, certain private companies that register their debt securities will need to comply with the climate-related disclosures. As a result, expect more time may be needed to complete registered exchange offers. And the proposed rules may push more private debt issuers into the Rule 144A for life market. That is assuming that the Rule 144A offering disclosures do not adopt the proposed climate-related disclosures, at least not in the scope that's being proposed. Impact on M&A. The proposed rules would have the effect of requiring public company acquirers registering the issuance of securities on Form S-4 to disclose some climate-related information regarding the target company without regard to whether that target company is public or private. And because the proposed rules do not provide any accommodations for those companies, that could have a meaningful implication on the timing of getting your S-4 filed and the completion of M&A transactions. The proposed rules also do not contain any accommodation for newly acquired entities. meaning that a public company acquirer will be required to include the full range of climate-related disclosures regarding an entity, even if it had not had sufficient time to review the entity's climate profile, emissions information, and other data. This, of course, is in contrast, for example, to the rules on internal control over financial reporting, which currently permit companies and auditors to exclude newly acquired entities from internal controls assessment. So if you've acquired a company in December, your internal controls assessment for that year does not need to include that newly acquired entity. No such dispensation in the proposed rules on climate. As a result, just to take away private companies, if they're seeking to make themselves attractive acquisition targets for public companies, should be cognizant of the rules and the disclosure standards as an on-ramp to getting a transaction like that done. Equity method investees, the rules also require companies to include emissions data on equity method investees on a proportionate basis. So as part of a disclosure controls and procedures process, companies will need to assess what contractual and other rights they have to obtain the information necessary to comply with this requirement, and consider any rights that are necessary to obtain information going forward on a timely basis. Obviously, many of those won't exist in constituent documents of equity method investees, because nobody ever forecasts that you'd need more than financial information, but here we are. With respect to new joint ventures and other equity investments, companies should consider including covenants requiring that this information be provided on a timely basis, similar to the covenants that we now negotiate around financial reporting and information necessary for financial reporting. Foreign private issuers, the proposed rules subject foreign private issuers other than Canadian issuers filing on Form 40F to the same obligations that apply to US domestic companies, which include the novel financial statement requirements that I worked through before. I would note that the SEC has asked for feedback on whether it should permit foreign private issuers that are subject to an alternative reporting regime that the SEC deems to be substantially similar to the proposed rules to be able to satisfy their obligations under the SEC rules by complying instead with the requirements of that alternative reporting regime. We'd expect that many foreign private issuers will provide SEC feedback on that request for comment. Finally, as to implications, the level of human and financial resources that public companies will need to devote to comply with the proposed rules really can't be understated. Given the limited phase-in periods and the scope and complexity of the proposed rules, companies will need to assess their readiness now and be ready to put in place disclosure controls and internal controls over financial reporting. Just to highlight, we have a long list in our client memo, but just to highlight some general areas of focus, think about where does climate information come from within our organization and who are the owners. Think about what information needs to be collected from third parties. How do you subject your climate disclosures to disclosure controls and procedures, and how do those disclosure controls and procedures need to be supplemented given the climate disclosure requirements? What do we need to do to prepare for third-party auditing of disclosures, and how long will that take us to become prepared? What internal controls need to be established is another question to ask. And finally, to Mark's governance point, do we need to add individuals with climate-related experience on our board of directors or our management team? Those people with that expertise will be in significant demand, and sooner that companies start thinking about it, the better. And as I said, that's just some of the highlights. With that, why don't I turn it back to Sarah, who's going to discuss the transition periods for the proposed rules.
Great, thanks, Bob. And before I do, just to touch on some of the questions that we've received in the Q&A, and to follow on what Bob said in terms of private companies, we can imagine that private companies, even those that have no plans to go public, will see a significant impact from these proposed rules if adopted. Because again, to the extent that they have a significant equity investor that's a public company subject to these rules, they may find themselves having to report to that investor. Similarly, the financed emissions concepts and Scope 3 emissions disclosures could require financial institutions also to be imposing reporting obligations on private companies. So again, it can be quite wide ranging even for those not subject to the current SEC reporting regime. On the transition periods, the memo that we put out yesterday has the full schedule of the proposed transition periods in the rules. I'll just mention a couple of the timelines for large accelerated filers. Assuming that the rules take effect in 2022, large accelerated filers with calendar fiscal year ends, the disclosure would take effect for 2024 reporting, so the 2024 10K. Notably, though, that picks up the 2023 information. So companies could see themselves having to begin collecting and having controls around disclosures as early as 2023. Scope 3 emissions disclosures would be effective 1 year later, so the 2025 annual reports covering fiscal 2024. For the attestation requirements around Scope 1 and 2 emissions disclosures, those would take effect 1 year after the disclosure requirements. So again, that would be in 2025, covering 2024 information. There's also a phase-in in terms of the attestation requirements. The first 2 years of attestation would be at a lower level of assurance, that would be limited assurance. And then in the third year, the assurance level would be reasonable assurance, which is the same level that applies to audits of financial statements. I'll turn it over to Mark, who will provide some nuts and bolts around the comment period and what we might be able to see in terms of areas of comment by various industry and other groups.
I'm going to be quick about it, just in light of the time. Comments are probably going to be due May 22nd. It could lag if the Federal Register publication lags. The SEC is using a relatively aggressive time period for comments, which is something that they have done recently on a variety of rules. What are you going to hear about? Look, you're going to hear about lack of materiality. You're for sure going to hear about that wherever it occurs, in the financial statement disclosures and the emission disclosures and the regular disclosures. You're definitely going to hear about that. 2, you're going to hear about the direct change to the financial statement disclosure without going through FASB. 3, you're going to hear about the lack of safe harbors, right? Safe harbors are super narrow in this. And you just heard from Sarah about the phase-in, right? There's like this whole phase-in for the different requirements and the scopes, and then the attestation. And the reason for all of that is because, hey, this is this is a brave new world, so to speak. And we don't know exactly how to do it, and we don't know what the disclosure controls look like. We don't know what the internal controls of financial reporting looks like, but there's no safe harbor for how your data changes over this period as we get better at it. That there isn't a safe harbor for. And you probably hear about the governance too, because it does seem like we're micromanaging, but that's only part of it. Sarah, I mean, I'm sure they'll hear from other folks.
No, again, the time period for the comments incredibly short, but a lot of people are gearing up and can expect vigorous debate in the coming 60 days at least. Jay, turning it over to you for just a minute. We would all love to have a crystal ball, but realistically, where do you think the SEC or this proposal will go from here, and what can we expect over the next coming months from your perspective?
So look, you and Mark covered the next phase, which is for the public to comment here on what the SEC has missed, underestimated, failed to consider, given I would say the scope, granularity, complexity of this, really what is a new reporting regime, commentary, and then the SEC staff to digest that commentary in the context. And let's not forget where we are here. The idea here is that you promulgate regulations in order to benefit investors in the marketplace. Okay. In order for investors to allocate capital in a more efficient way and companies to be able to communicate with their investors in a way that makes that entire process more efficient. How much effort the SEC makes to assess that is sort of a wait and see. But it's a difficult task. And I think that that's going to be something that they calibrate the final rules based on how comfortable they can get with that analysis, and that the final rules will stand up to scrutiny from a cost benefit facilitating better investment process. And I'll just say that that's not easy here, because you have to assume that you've got the direction of travel on transition correct, or at least that these rules will help it become more correct. That's a big assumption. And, it's not an assumption that the SEC is in the best place to make. So we'll see how much more input they get on that. For example, exactly how you allocate capital across various industries going forward to facilitate transition. How do we know that that's correct based on these metrics? Anyway, there's a lot of complexity here. It's what the comment period is designed for. I would encourage people to comment. The last thing I'll say is going back to not being aspirational. You also should not be afraid to say you don't know. It is okay in disclosure to say, I don't know how this is going to affect me over time.
On that note, maybe we can turn to questions. So we have a number of questions, and Sarah, we have a number of questions about how to calculate and disclose your scope 1, scope 2, and scope 3 emissions. And so I thought I might sort of pull those together. So one is, do the rules specify any methodology for determining scope 1, 2, and or 3 emissions? The second would be, what is the definition of materiality when evaluating scope 3 emissions? And the third is, if you currently report only 1 or 2 components of scope 3, would you have to report all of the components now?
These are all very good questions, some of which have some answers and some of which we expect will be the basis of comments as people look to have additional clarity around these answers. In terms of methodology, the proposed rules generally tracked the existing greenhouse gas emission protocol. So there is some sort of basis in terms of how people look at and calculate these emissions disclosures. And in that regard, it's not an entirely new regime for companies. But that being said, there's a lot of subjectivity and judgment that goes into all of these types of calculations, and the SEC really has not wanted to adopt a very specific framework in terms of these rules. In terms of materiality, the SEC throughout the proposing release really focuses on what is material to a reasonable investment decision, what's material to an investment decision, what's material to a voting decision. And so unfortunately, the answer is there's not going to be a clear answer. It will vary based on company. It will vary based on their industry, based on what information is valued and viewed important by investors. And it's going to take a lot of work over the coming months to really kind of calculate and assess where people are in terms of their current emissions data, and then what rises to that disclosure threshold. But unfortunately, the answer for all of us is there is no clear answer in that regard. And then the third question is on to the extent to which people are incorporating some emissions scope 3 emissions into their current goals and targets. I think we expect or hope that there will be more clarity in the rules, but I think there's a basis to say you would have to incorporate and talk about scope 3 emissions if you've already incorporated some into your targets and goals. But again, we expect that to be an area of focus, and as people look for clarity in these topics.
Yeah, and Sarah, on scope 3, I mean, I think the proposal says that you don't have to disclose scope 3 if it's immaterial, but you're going to have to do scope 3 work to make the determination of whether it's material or not, correct? And that someone challenges you and says you didn't disclose it. How do you know it wasn't material? You have to say, well, here's the work I did to conclude that it was not so, correct?
That's correct. And unfortunately, because again, the nature of scope 3 is it's the entire value chain, the amount of work that potentially people are going to have to do to even make that determination is quite significant.
Great. Jay, I'm gonna give you one easy one and one harder one. The first one is a question that notes that someone just received an annual report and proxy statement from a major bank, and it is incredibly long. Obviously, no one can read it. I'm paraphrasing, otherwise very funny, but also long question. Can we expect the SEC to return to the idea of disclosing material facts as opposed to all this?
Well, I think the answer to that is no. The SEC reporting framework has proven so successful for investing based on financial, operational, strategic information and the value of that information that it's now used for many other things. And whether Congress mandates that or the SEC decides to do that on its own, that is a direction of travel that we have seen since Sarbanes-Oxley, more in Dodd-Frank, and now with what you're seeing with cyber, what you're seeing with environmental, and what you're seeing with human capital. There is a change from management, tell us how you look at these issues, so we can assess how you look at them, to here's a framework for how we believe you ought to be looking at these issues, disclose against that framework. That is a fundamental change that has happened over the last 15 years.
And the second part, or at least the second question related to that, is do you think there's grounds to challenge the rules as beyond the authority of the SEC as overly broad?
So back to that framework change, if Congress says, let's use the SEC framework to achieve something else, think about conflict minerals, think about resource extraction, some of those issues, there's no legal challenge to Congress. If the SEC does it sua sponte, there are areas where you can challenge and say that this is beyond the SEC's scope of authority. For example, a question that may come up here is the major question doctrine. Should this have been done in conjunction with the EPA? And together with the EPA and the SEC have the administrative authority and expertise to put forward a climate disclosure and management regime for companies? Or did the SEC have enough authority on its own to do that? Or is this something that's so broad and important that Congress should have done it? I expect that issue will come up in the comment period, and I expect the SEC will try to address it in any final proposal.
We're running out of time, but Cathy, there are a couple of very practical questions. One question notes that the company currently issues its TCFD report several months after the 10K. And the question is, do they now have to provide that information at the same time as their 10K? And if so, what are the considerations for in-house legal teams in light of this timing difference and the different liability framework?
Yeah, thanks, Mark. I mean, this is a significant challenge with the timeline, is because many companies, do release these reports months after the audit's completed, after they've filed their 10K. And so it accelerates the reporting. And add on to that, the attestation requirement and an audit covering, particular aspects of climate-related disclosures. I think in-house counsel is really going to need to think about mapping out kind of how you get to, from point A to point B, which is going to involve a lot of, pre-planning in ways that, I know companies now start planning for their 10Ks in November or December, if not earlier. I think advanced planning is going to have to be months in advance because there'll be limited resources, obviously, within the company, and thinking about whether additional resources may be necessary just to get these documents completed in a timely manner.
Well, Cathy, I note that we've come to the end of the hour. I think you were destined to
Yes,
send us off.
I will wrap it up. So thank you all for joining us today. Obviously, this is a really important topic for you all, and it's something that we as a firm are very focused on. We've dedicated resources across our many practice areas, and we stand ready to help you think about next steps, and planning for the proposed rules should they be adopted. So please feel free to reach out to any of us with any questions. I know, Mark, I'm sure we didn't get to all of them. And we look forward to speaking with many of you about this. And with that, thank you all so much for joining us and have a great day.
Thanks all.